There is a trick to quickly identify thriving companies, and it's called the dividend triangle.
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well. I am with my co-host Véronique, and today we're going to have a very interesting discussion about kind of like a classic model, but it's good to revisit our classic from time to time, right, Vero?
Right. So for this episode, we return basically to our basics. Investing doesn't have to be complicated and includes like dozens of metrics, despite like what most investors think. So focusing on trends for 3 metrics, which we call the dividend triangle, can cover most angles.
Yeah, when I started to invest in dividend growth stocks, that was back in 2010. And back then, I kind of made like the same thing as any other investors. I started to make a long list of metrics and checks, including the payout ratios, the PE ratios, cash flow, revenue, dividend, like a lot of things. And then as I continued my journey into that path, I kind of realized that a lot of those information were kind of like making sense and in ends. It's like, I mean, if you look at a hockey player and he scores a lot of goals and he does a lot of passes, well, he's going to rack up a lot of points, and chances are he's going to end up with like positive plus and minuses. I mean, there are some exceptions, of course, as any other things, but there's kind of like a package that started to emerge. And I realized that by following 3 metrics a little bit more precisely, I was able to wrap up the narrative around the stock and explain pretty much any other financial metrics just by using the dividend triangle. So on one side, it's kind of like basic stuff, but on the other, it's really the foundation of how I started investing and really simplified my life to select thriving companies.
All right, so for the benefit of our first-time listeners, let's first quickly define the dividend triangle, Mike.
Yeah, I wish one day it's going to be part of like financial studies, but I have big doubts about that. So, of course, if you're looking to read about the dividend triangle, unless you read something that I wrote, you're not going to find anything. So the dividend triangle is based on 3 separate metrics. So we look at the revenue, the earnings per share, and the dividend payment. Most importantly, we don't necessarily look at the numbers or the growth rate over like the past 5 or 10 years, but more about the trend. So we look at how the revenue evolves year after year over a long period of time. I prefer to use the 5-year graph, but at DSR, we provide 10 years. But the first 10 years of the first 5 years of the graph will more likely help you to identify cyclical businesses. Because, I mean, let's be honest, whatever happened in 2015, 2014 is not exactly what is happening right now. So the economic environment changes very quickly. And therefore, looking at what really happened between the growth of like 2015 to 2018 will not tell you much about what's going on. At the same time, right now, in the middle of the dividend triangle, we have 2020, which kind of like create a lot of distortion in the graph. So it's important to see what was the life before and life after 2020. And then you have a much better comprehension of where the company is going next.
Okay, so why should investors follow the 5-year revenue trend first?
So when you invest in a business, what you want as an investor is a business that is able to grow, right? So the revenue trend will actually answer this question. You will see if the business have found ways to sell more of their products, have probably like good marketing or something like that. Maybe they will grow by acquisition. So showing a positive revenue trend is very important because it's really hard for a business to make more money, be cash flow positive for a very long time if revenue continues to go down every single quarter.
And when looking at the revenue trend, what does become a red flag?
First, I like to say that whenever there's a big movement, either like a slowdown or a big upside, it's more like an invitation to investigate. So the point here is to understand what happens from one quarter to another that will actually push the revenue trend higher up or higher down. Of course, in terms of red flag, well, when you see the revenue that is slowing down or declining, it's definitely a red flag. It's not the thing that you're going to say, oh, there you go. It's been 2 years, the revenues are declining or reach a plateau, so I'm going to sell the stock right away. But it's already one sign that it's not doing that well, of course. I mean, if you're thinking about like look at it as if you when you think about your career, if you do not get a pay raise for 1 year, for 2 years, and then a third year, your boss says, "Well, I'm going to keep you, but I'm just going to drop your paycheck by 5 or 10%." Well, I mean, chances are he doesn't like you that much, or the company doesn't go that well. But in both cases, this is definitely a big red flag. To find those explanations, because it's one thing to say, okay, so right now revenues are not growing anymore. What's up? Like, what's going to come up next? Well, then you have to go into the quarterly earnings. We have discussed that not too long ago. So reading the press release, going into the investor's presentation, and maybe train a GPT so it can scan the entire earnings call and tell you and highlight what was really important there. So whenever I see that there's a revenue stagnation, the first thing I will do is I will look at like the past graph for the past 10 years to see if it happened before. So a good example would be Apple. So when you look at the past 10 years, you will realize that Apple goes through product cycles, which means that whenever they come with a new product with a lot of innovations, it will create a uptrend in the revenue. After that, it could generate like 4, 5, 6 quarters with not much revenue growth. Is it a time to panic? Well, not necessarily, because once you know that it goes through like product cycles, and after your complete analysis, you will also know that Apple generates a lot of cash flow and it has the ability to inject in its products and fuel more innovation down the road. Then you can think, okay, so I'm willing to be a little bit more patient with a company like this, as opposed to another business where you see that the revenues are not growing, but there's like nothing that is being better or like no innovation or no product cycle or no other explanation to say why the revenues are struggling. And we could see that for mature businesses. The telcos these days have like very stagnant revenue. They grow by like 1-2% every quarter, which is not much. And at one point you can start to be a little bit more concerned about that long-term trend. So the point when you do that investigation is to determine, will the trend continue? Like, is it going to remain as a plateau? Is it going to go down? Or is it just like the economy entering into a recession and we have to just endure weaker revenue for a few quarters or maybe a couple of years before it comes back? So when you are able to combine the metrics, so the growth for the past 10 years with the current narrative, once you have a good explanation, then you're in a better position to know if the company is just facing temporary challenges or if it's going to be the next new norm. And then you start taking mental notes that maybe you will have to get rid of this company sooner or later.
Okay, so then earnings per share tell us more about the business profits, which, it's kind of related to revenue, but it's totally different at the same time. So how does a growing trend protect investors for EPS?
So that's the next step. Once you found a business that is able to generate more and more sales, well, the second thing that you want to make sure of is the business making more profit. At the startup stage, a lot of businesses will show amazing revenue growth, but they will struggle to generate profit, which is totally normal. They try to gain market shares. They reinvest massively in their business to grow fast. And that makes sense, but that will likely not make them dividend payers. So maybe it's going to be a great model, investing model for you guys if you do not focus on dividend growth. But on my side, if I don't see earnings per share going up, it's going to start to raise another red flag. Of course, earnings are based on accounting principles. It's not perfect. In a perfect world, we would be tempted to look at operating cash flow or operating cash flow per share instead of earnings. The problem then is the cash flow is a lot more hectic than earnings per share. Just think about how your bank account fluctuates from one week to another, from one month to another, depending if you go on vacation, if you have special expenses. So it's a little bit harder to see a smooth trend, and usually the cash flow will fluctuate a little bit more, and it's sometimes a little bit harder to get it per share instead of the earnings per share. So for the EPS, it's true that you can play around with accounting rules for like a few quarters, maybe a couple of years, but over 5 to 10 years, there's a limit of what you can put into the impairments or the amortization or any other non-cash event. So eventually you're going to have to tell the real story as of, is the business profitable or not? So a company that has growing earnings per share, well, it's a company that will show pricing power, that will show healthy margin, that will also show like a robust demand for their product or services, because on one side, the revenues are growing, but if you offer something that is of good quality or really good, well, consumers are going to continue to buy your product, and then you're going to be profitable. So a weak earnings growth combined to a strong revenue growth, for example, would tell you that the business has to spend a lot of money into marketing to grab market shares. Maybe there's a lot of competitors. Maybe the margins are very thin. So it will tell you a little bit more about the relationship between the revenue and the earnings. So in an ideal world, you would like to see revenue and earnings per share growing about the same pace. So that would be like the perfect dividend triangle would be a company able to grow between 5 to 10% per year in terms of revenue, but also in terms of EPS. So then you know that the expenses are not growing up, and the company is just able to maintain the margin as it grows.
All right, but Mike, sometimes the EPS growth trend is not like a growing line, steady line. So what does a warning sign look like for EPS?
We wish, right? We definitely wish that everything would be straight lines towards the sky. It would make our life so easy as an investor. But unfortunately, you're right, it's not. The thing that I hate the most, actually, it's not necessarily, well, of course, when earnings per share are slowing down, it's a big red flag. But the thing that I hate the most is when it's hectic. So you have like a very good quarter, a very bad one, a very good one, and then 2 quarters in a row that you have declining earnings. And when it goes up and down like this, it's really hard to wrap up your hand around where the company is going up next. It will often happens if the business makes a lot of acquisition, for example, because then you have like the cost of acquisitions, you have the amortization, sometimes like a reassessment of the value of the asset that was acquired a few years ago. So you can have like a lot of like items added in the financial statements, and then it's going to be a lot harder to wrap your head around what's going on there. So whenever it's hectic, whenever it slows down, it is possible that you will see a company showing better revenue growth, and then the earnings going to flat out for a few years. Well, then you need to go deep inside the financial statements and look at the expenses. So are we talking about non-cash event, as I mentioned earlier, like amortization, impairment, stuff that will not affect the cash flow? Or are we really talking about a company that is forced to spend more money or has interest charges going up, for example? So a business that sees the revenue that continues to go up, but now the cost of operating the business has completely changed because they have like a high level of debt and they see interest charges going up very quickly. They have to spend more into marketing, into sales representatives. And eventually the business is not as profitable as before. Well, then you have to ask yourself, is it a temporary measure or is it going to be the new reality going forward? So once again, a good way to do that as well is to look at the cash flow statement. It will tell you a little bit more about what's happening with the cash flow movements. So if the operating cash flow and the free cash flow is not enough to cover the dividend, it's going to raise another red flag. And because sometimes the earnings per share, and I would say that's probably like the biggest flaw here, is it's not always the best metric to use. So the key is to navigate between the EPS and sometimes look a little bit more about the cash flow statement, because in the end, both metrics will lead to the dividend payment.
The last trend we want to look at is the dividend growth. What does it tell investors?
Well, it will tell you if the company is healthy, if it has a robust balance sheet, and most importantly, if management is confident in the future. Of course, investors will see the dividend as a reward. It's a good thing. It's a paycheck. Some even see that as almost like magical money because it just appears in your account every quarter or every month. But in reality, from the business perspective, it's another expense. It's another item in their balance sheet, in their financial statement, where the money is going out of the account. The worst part is they don't get much out of this. They're just like spilling away money, just based on the very principle that if the company does not have like great projects to create value for shareholders, it's better off to redistribute a part of their profit to those shareholders so they can reallocate that money elsewhere and make a better use of it. So that's the entire principle around that. So when you find a business that shows revenue growth, so that means that the revenues are increasing, like better sales every time, and then it's more profitable, well, it should lead to higher and higher dividend payments. And the consistency in a dividend growth will also tell you a good sign that the business should continue to thrive going forward. So it's more like the result of what happened over the past like year, 5 years, 10 years. So if you have like a well-managed business that is highly profitable, well, then the result of that should be having a dividend that increase every single year.
Mm-hmm. And when does the 5-year dividend growth become a concern?
Again, whenever there's a slowdown, you have to wonder what's going on. The example that I can think of right now is Bell, BCE. It used to always increase its dividend every single year, clockwork, by roughly 5%. In 24, big surprise, they came with 3%. A lot of investors said, it's not big deal. Well, it is a big deal if you start digging. I mean, of course, you're just like, oh, well, it matches the inflation. It's all good. The dividend is still safe because they increase it, so I don't have to worry about it. But then you have to go a little bit deeper to look at the cash flow statements to see what's going on with the business. And then you kind of realize that everything starts to get a little bit more tight in their business model. So it's going to be very difficult for Bell to increase their payment in 25. Now, they recently got downgraded by credit agencies as well. So kind of like raising another red flag, telling you maybe there's something not that well doing with, maybe there's something wrong going on with BCE. And it's not just about panicking, but rather about like looking at the numbers in their face. And of course, you should never trade just based on one metric slowing down. That could happen. Capital Power, CPX, has recently announced that they will go from a annual dividend growth policy of 6% per year to 2 to 4 because it's a utility company. They made a lot of acquisition as of late, and it's just like kind of like a prudent management. On the other side, when you're investing in those type of businesses, you should not expect amazing growth all the time, but rather you aim for stability. So Capital Power also explained that they target a lower payout ratio moving forward. So that also explains why they still intend to grow their earnings per share faster, but they just want to be on the safe side, going for 2 to 4%. Of course, it's not a great news, but it's just telling you that the easy money has been made. Now it's more about being that good old utility that will generate some cash flow, will share the profit with the shareholders, but do not expect this one to go head to head against Alimentation Couche-Tard in terms of growth. That's not going to happen. So it's once again, very important to put some context around the numbers and understanding what's going on. So for Capital Power, I'm not really worried because the funds from operation per share leads to very low payout ratio and the earnings per share as well. As of when you look at Bell, we're getting into the territory where most of the time the payout ratio is between 90% to 100. So there's little room for growth. And if there's any room for growth at all going forward.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. You know, our goal is to help more investors just like you, so please spread the love. Thank you. But Mike, you kind of already explained what metrics you look at when those red flags appear, but what's the difference between a red flag that you're gonna wait and see what happens and one that you're gonna sell your stock?
Yeah. So when you see a dividend triangle that is weakening, and it could be like one part of it, so maybe the revenue, maybe the dividend or the earnings, or all of them. So of course, if you see everything that is slowing down, that's a huge red flag. And the point here is to find the explanation. You need to understand what's going on. And if you cannot understand and you just tell yourself some stories, well, this is where it's going to get bad. You need to be able to explain why the dividend triangle is weakening. And sometimes there are like pretty solid explanation. I mean, in 2020, with the lockdowns, there are a lot of companies that were struggling, but that was explained by the environment. If we go into a recession, of course, you're going to expect a lot of companies to slow down, and it's normal. You cannot expect for companies to always go up all the time. So, for example, we had a few episodes on this show where we talk about stocks I dislike, or sometimes I just like to say that I hate them with a passion. But they often show a mix of a bad narrative and a bad dividend triangle. So, it's, in other words, once you found the explanation why a company is struggling with the numbers, and then you realize that the business is just not able to find growth vectors and will likely not be as profitable as it was before. Well, then you're getting closer to a sell. And when you have a weak dividend triangle, the possible of a dividend cuts increase greatly. So it's not a time where you should pounder for like 5 years, whether or not, or wait for that dividend cut to happen, because whenever it happens, the market kind of like see it coming. You will see the stock price going down for a while. And once the cut happens, most of the time there's a final drop in the stock price. And at this stage, I mean, you lost your revenue, you lost your capital, and it's a bit late to make a move, even though it's never too late, because after that, probably the company will take years to recover. So again, not necessarily a good idea to keep on holding those companies. So the point is, again, making that match between the investment thesis, the narrative, and the dividend triangle. And when both together are not a match and you cannot find explanation why you believe this company will thrive, but the numbers are not there, you might as well just let this one go and focus on something that you can understand and you have a stronger feeling about it.
On the other hand, do you have examples of companies showing a perfect dividend triangle?
Fortunately, there are a lot of them. Most of them are, of course, low yield, high growth stocks. So on the US side, classic example would be MasterCard and Visa. They have like a recurring business model. They're, of course, cyclical. So you will see their dividend triangle weakening during recession because consumers use less their cards. And if they do, well, they're making less fees on those transactions. But in general, they grow high single to double digits for revenue, earnings, and dividend. Costco is another great example. This one is a little bit harder to follow because almost every year, every 2 years, they also come with a special dividend payment. So you're going to see like big jumps in the dividend in the dividend graph. But overall, even if you exclude those special dividends, the original quarterly payment increased every single year. Microsoft is another one that shows something quite stable over the past 10 years. Of course, driven by a lot of growth vectors, so it's going to help. And it's always good to see when a company is able to grow their revenue and earnings on a steady basis and remains relatively cautious about their dividend payment. They could increase their dividend a lot faster, but they also know that they can use their cash flow for better intent and create more value.
Mm-hmm.
On the Canadian side, you have companies like Dollarama, Alimentation Couche-Tard that I never talk about, and of course National Bank. That is
That
like
you never talk about.
yeah, I never talk about. But this one, I had to highlight it for another reason, though, is all the other stocks that I've mentioned show very low yield, while National Bank is still paying at between 3 to 4%, depending on when you buy it. So this one offers a decent yield, but a very strong dividend triangle at the same time. The downside of this is everything is temporary. I mean, business changes, the environment changes, the economy changes, politics change. So, unfortunately, what really works today may not work in 5 years from now. And if you go in the past, I mean, Microsoft was not always this thriving companies. They had like years with bad results. National Bank, the same thing. Even Couche-Tard not always increase the dividend every single year, because when they make big acquisition, and now there's like a lot of chatters about the I would say the attempt to acquire 7-Eleven. So if it ever happens, I'm pretty sure they're going to skip one dividend increase. But again, it's not because they are struggling. It's because they have like a huge bite to chew on. So you have to, again, put that into a context. And I mean, all the companies that has a strong dividend triangle today, it's great, but it doesn't necessarily mean that automatically they will show a great dividend triangle in the next 5 and next 10 years.
So, Mike, we have created a free stock checklist to help investors focus on the dividend triangle. Can you tell us more about it?
Yeah, this checklist will be very useful, especially if you hesitate, if you suffer from paralysis by analysis, or if you just look at your stocks, they're going down, and you know you should dig a little bit deeper, but you just keep telling yourself that everything's going to do well because those companies have been around forever and they've been paying a healthy dividend for a long time. Well, now it's time to get rid of those stories, get rid of emotions, and get back to facts and numbers. It sucks, but facts don't lie. So when you look at the rational part of your analysis, then it's going to make it clearer if you should keep a stock or not. And again, going to circle back to my story around BCE. I know that I've been talking negatively about BCE for about almost 2 years now. And since then, a lot of investors are telling me, Mike, you panic for nothing. You worry for nothing. They've been around for so long. And I'm like, well, first, I don't panic. I don't have it in my portfolio, so I don't mind that much. But every single quarter, I look at the numbers and they're not getting much better, if not better at all. So this is like a bad story developing quarter after quarter. And right now I'm getting to a point where I am not convinced that they will be able to turn that around. They need to show some growth and they need to get their cash flow under control. And quarter after quarter, I repeat the same thing and they don't do it. So that's not necessarily a great sign. And again, I don't have it in my portfolio, so I don't have to mind too much about what to do with it. But having that kind of like checklist will kind of like bring you more about looking at the numbers in their face and realize if the numbers are agreeing with the story that you tell yourself about a stock.
Mm-hmm. Mm-hmm. And you know what? I checked the numbers for Bell and I sold it. So just all right. So listeners, to download the DSR stock checklist, enter your name and email at thedividendguideblog.com/checklist. Are there any specific cases in which the dividend triangle does not work? We've mentioned EPS earlier. So if so, what do you use instead?
Yeah, so the biggest flaw of the dividend triangle is definitely to use the earnings per share. Some companies, the earnings are definitely not the right metric to follow. We can think of REITs, for example, but also sometimes for utilities, pipelines, anything that is like capital intensive, it's going to be a little bit harder to monitor the EPS and understand what's going on. So sometimes you're better off with funds from operation per share, for example. But since the FFO is not a GAAP, so a generally accepted accounting principle, you have to rely on the company's calculation. Sometimes you're not going to get the exact same number if you're using one financial website to another. So it makes it a little bit harder. So what I do instead is I will look into the company's investors presentation and the quarterly earnings to get those numbers per share and then calculate the payout ratio. Most of the time, those companies already know that the earnings per share is not the right metric to follow to determine if a dividend is safe or not, or if the business is actually doing well or not. So they will provide you the payout ratios based on funds from operation instead of just giving you the false impression that they are going under and not profitable. So unfortunately, it requires additional work because in those cases, the earnings per share graph is completely useless, and just relying on revenue and dividend is not enough. It's going to be a good starting point because, of course, if a business keeps on increasing its revenue and also increase its dividend, chances are they're making more money on one way or another. So cash flow should be positive, but again, you cannot just like look at a few metrics and then close your eyes and click on the buy button. That's not enough. You need to do that due diligence every single time you look at a business. And yeah, the dividend triangle covers a lot of ground. It's not perfect, and it's a good start to investigate stocks, but it's definitely not the only thing that you should consider.
All right, so can you quickly summarize how the dividend triangle covers most angles?
Yeah. So when you look at the revenue, like growing revenue will tell you that the company may have a moat. It may gain market share. There's probably growing demand. Chances are there are some a good base of recurring revenue as well. The business is probably stickier than others. So meaning that consumers or clients have a hard time finding replacements, so they will stick around for a longer time. Like think of like Costco, for example, with their membership. That's a lot of recurring revenue, and that's a very sticky business. Once you have a Costco card, and I like Costco as much as I hate going there, but still, you will find me at Costco buying stuff because it's just so convenient and easier for a lot of things, especially when you have a family. So again, business is stickier. They will show ability to grow, and also you will see if they grow by acquisition with like large revenue jump. So when you just look at the revenue trend over the past 5 to 10 years, there's a lot of narrative and a lot of other metrics that could be covered. Now, when you combine that with earnings per share, well, it will tell you what's going on with the margin. So stagnating revenue, growing earnings per share, for sure, they went into a cost-cutting program, and now they found ways to improve their margin. That's great, but you also know that the EPS cannot grow at 10% per year while revenue grows by 2% a year. It's not going to happen for so long. So at one point, they will need to find growth vectors. It's going to cover for the margin. It's going to cover for the cash flow. Because in general, when you find a company that is profitable and growing their profit, well, the cash flow will kind of follow. It will also tell you a little bit more about the pricing power. Because again, if revenue increase and the earnings increase accordingly, well, then you know that the company is able to grow, to increase their prices and still make a lot of profit. And overall, it's also a good sign of good management because, of course, if the company is profitable, everybody's happy, and management has one thing or two to do with that kind of result. Finally, when you look at the dividend trend, if the dividend increases, well, it will tell you that there's a lot of trust and confidence from management that they will be able to maintain that dividend and continue to grow it going forward. It will also tell you a little bit more about debt because, of course, if you have a strong dividend triangle, chances are debt is under control. So they are able to manage their debt and still increase the dividend. So that, again, they see that as another expense. So from the business perspective, paying interest charges, paying their payroll, and paying a dividend, it's pretty much just money getting out of the account. So it's also important to make sure that they can cover all their business expenses for sure. Growth expectation. If the dividend keeps on growing, it will also tell you that the business is quite confident that they are able to create that balance between growing the business and growing the investor's paycheck. Finally, all of this is not possible if you do not have a robust balance sheet. So strong dividend growers for many years, when you look at their balance sheet, you will realize, oh, they have like more assets than debts. They're like the debt is under control and they have like quality assets. It's all going to be covered by a strong dividend triangle once again.
Well, thanks a lot, Mike, for making our investors' lives easier. Listeners, remember to download your free copy of the DSR stock checklist at thedividendguyblog.com/checklist. For the show notes and related content, visit thedividendguyblog.com/195. To avoid missing any episodes and help us grow our audience, hit the subscribe button now and leave us a 5-star rating. Until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.